is adopted.
Big Beautiful Bill, what's inside of it, and what amendments have changed in the last few days. So let's cover everything, including some of the more unique components you may not have heard of before. Let's keep it as straight and simple as possible so we can stick to the facts as much as possible. This is a deficit spending bill, which basically means, yes, it is likely to add to the debt. The CBO says up to $3.2 trillion. Cato, which leans a little bit more left, says it's going to cost over $6 trillion. Tax Foundation, which leans a little bit more right, tells us that it's going to grow GDP by over 1.2% on top of whatever our GDP was going to be starting next year. And so that's where everybody's going to have their own opinion on if that's good or if it's bad. Basically, no matter how you slice it, we're taking on debt to borrow from the future to give to the now and boost the economy. One of the components of this bill that was recently added through amendment is a little bit of a unique one, and it has to do with gambling. Under the Tax Cuts and Jobs Act of 2017, if you were a professional or casual gambler, you could deduct up to 100% of your losses against your winnings. But you could only include your travel expenses and other business expenses as part of your losses. So in other words, if you made $100,000 and you lost $100,000 in losses and travel, you could net those two against each other and pay no taxes. Now, the amendment maintains that. However, it says you are limited to a 90% deduction on losses, which includes business-related expenses for gambling-style wagers, which means if your travel expenses, hotels, or whatever worked up to $100,000 of losses and actual gambling losses and your earnings were $100,000, you'd actually be paying taxes. So you'd be coming out of pocket $3,000 to $5,000 in that case just to stay in business, even though you didn't make any money. It sounds like a sin tax, and it was just slid in. It appears to apply to professional gamblers in LLCs or not. Interesting little add-in. Charitable giving. There is an increase in the charitable giving limitation, or sort of deduction, I should say, if you take the standard deduction, which most individuals take the standard deduction. If you take the itemized deduction, you'll have a floor of 0.5% of AGI for deductions on donations, which kind of takes away some of the benefits of donating if you're itemizing, or if you're a corporate donator, that is a 1% floor now. But for most normal folks taking the standard deduction, instead of having a $600 limit on how much you could donate and actually write off against your taxes, if you're single, you can now donate up to $1,000 worth of stuff and write that off on your taxes while taking the standard deduction. And if you're a couple, $2,000. So what does that mean? Well, I don't know. Let's say you have some old AirPod Pros and you actually have the AirPod Pros and you go donate them and you say, hey, this has a value of $300 or whatever, and you're a couple and you donate, I don't know, 6 of them. Well, you could write off $1,800 on your taxes. Now you don't have to deal with the time of trying to resell your product on eBay or whatever. You just donate it, take the tax credit. Kind of cool. So this is a nice benefit for individual households taking that standard deduction. As far as the car interest deduction, there are a lot of people wondering, hey Kevin, does it make more sense to buy a car now or wait until next year when I can get the car interest deduction? Remember that this big beautiful bill includes the opportunity to deduct up to $10,000 in annual vehicle interest. Now this would be on the personal side, since remember you can already deduct 100% of your business interest expenses. So for a personal car on a new auto loan, on a new auto, so in other words, it has to be a new loan, and on a new car, that car has to also then be assembled in the United States. You could potentially deduct up to $10,000 in annual vehicle interest. Quick example of that, if you go finance a Tesla at, let's say, $40,000, and you pay roughly 5.5% interest on that because maybe there's no interest benefit such as like a 0% APR or whatever, which would lower the benefit, obviously, of the car interest deduction. Well, in this case, you would end up saving probably somewhere around $600 to $900 in actual money. That's money you would save at the end of the year by writing off interest on about a $40,000 car loan at 5.5%, saving somewhere again between $500 to $900 depending on your tax bracket. Well, if you compare that to the $7,500 electric vehicle tax credit that you get if you buy an electric vehicle before September 30th, you can clearly see that the electric vehicle tax break of $7,500 should you want an EV is worth about 10 times as much as this car interest deduction. And that car interest deduction only applies to the years 26, 7, and 8, which means that the car interest deduction doesn't last for the life of the loan that you have the car. If you're going to get a 5 or 6 year loan or even a 7-year loan, like an 84-month loan, you're not actually going to be in a place of reaping all of the benefits of this vehicle interest deduction, which makes that $7,500 tax credit, which is a full $7,500 off your taxes, really valuable. Most people would have to deduct somewhere between $15,000 to $20,000 in deductions from their taxes to actually get $7,500 worth of tax credits. 3% back in Bitcoin rewards when I spend on dining, gas, and more rewards for other categories. Introducing today's sponsor, Gemini Credit Card. Many of you know I'm a fanatic when it comes to credit cards because, well, we got a lot of expenses. Groceries, gas, fuel for other vehicles, takeout, it adds up like crazy. And today's sponsor of the video is Gemini. Introducing the Gemini Credit Card. It does something that most cards don't do. It provides instant crypto rewards, while other cards give you points you might forget to use and redeem later. We've all done it. Those travel points, those Marriott points, some of them, they're a little harder to remember to follow up on and redeem. I don't know how many points I've got at how many different credit cards, and it's like, I know I've got them, but dang, I need to actually use them. Gemini instead lets you earn crypto the moment you make a purchase with no waiting and no extra steps. Here's how it works. You get 3% back on dining, 2% back on groceries, 1% back on everything else, and 4% back on gas and transportation up to $300 per month. You can choose over 50 different cryptocurrencies to redeem your rewards in, including Bitcoin, Ethereum, Solana, and switch your selection at any time. I chose Bitcoin. And what's crazy is Bitcoin rewards held for a year on this card have appreciated 176% on average. Now, obviously, those are historical numbers, but let's just put it this way. This means you're kind of investing your credit card points as you're spending. This card looks great too. It's made of stainless steel, doesn't show your card number, and comes in 4 different colors: black, silver, rose gold, and Bitcoin orange. I picked black, and personally, gas and dining have been my biggest reward categories so far. There's no annual fee, and you can see if you pre-qualify without affecting your credit. And right now, if you apply using my link, gemini.com/Kevin, you'll receive $200 in crypto when you're approved and spend $3,000 in the first 90 days. If you're already spending this money, you might as well earn crypto rewards that could grow over time. So check out the link down below, gemini.com/Kevin. Because remember, credits offset the taxes you owe 1 for 1, should you, of course, owe taxes. Now, of course, not everybody wants an electric vehicle, and keep in mind that the car interest deduction does phase out once your income goes over $100,000 for a single or $200,000 joint. Basically, it's not that if you make $101,000, you go to zero that you can claim on this. It just gets smaller over time the more you make over $110,000 and fully fades out pretty soon into the lower 100s. Consumer Financial Bureau Protection Bureau funding is being cut in half. That could end up reducing some of the protections for lending for consumers. However, if you reduce protections in lending for consumers, you might actually also see new lending products pop up. So you might actually have more opportunities for more potentially riskier but different kinds of loans in the future. Medicaid has been a big popular argument regarding the big beautiful bill, and basically the way Donald Trump brands this as reducing waste, fraud, and abuse is by saying, hey, we don't want illegal immigrants being eligible for Medicaid anymore, such as how California enables illegal immigrants to get Medicaid, and we want people to work. So if you do not have children who are under the age of 14 and you are not disabled, starting in 2026, you will have to work 80 hours per month, or approximately 20 hours per week, up until you are 65 years old in order to receive Medicaid benefits. You would also have to pay approximately a $35 copay for all Medicaid services. Regarding SNAP benefits, SNAP benefits start in 2028, or changes to SNAP benefits start in 2028. And basically, gets a little complicated between states and the federal government. Essentially, if a state has an error rate on their SNAP or food stamp benefits program of less than 6%, they're fine. Not much changes here with the exception of work requirements, which there will be work requirements as well starting in a few years. However, if a state like Alaska, which has an error rate on food stamps of somewhere around 25%, has an error rate of 6 or more percent, then states are going to have to start contributing to the food stamp program from their own pockets against what typically the Federal Reserve or the federal government pays for. Not to be confused with the Federal Reserve here. This bill does not affect the Federal Reserve at all. It really has nothing to do with the Federal Reserve. It's entirely separate. This is a fiscal policy bill, whereas the Federal Reserve deals with monetary policy. Put simply, Congress is blowing debt money. Federal Reserve prints money out of thin air, and they control interest rates. Okay, separate things. All right. And yes, they don't technically print anymore. They just change digits on a spreadsheet. All right, anyway. Immigration and security. This is a big one. We are including in this package over $350 billion for immigration and security. Just some of those subcomponents are going to be $25 billion for the Golden Dome, $46 billion to finalize the construction of the border wall, $45 billion for 100,000 bed migrant detention facilities. Presumably companies like Raytheon, who make the Patriot Air defense solutions, would be big beneficiaries of this. There's also, of course, talk about the $1,000 deposit for the Trump accounts as seed money. This is basically where if a child is born during the Trump administration, they would end up qualifying for a tax account that could essentially be deposited into into the stock market or some form of index that hasn't exactly been decided yet exactly what they will do with this. But it's essentially a tool where accounts would receive a $1,000 deposit from the government made for children born between 2025 all the way through the end of 2028. There are some notes that it might end up going for the extra 2 weeks to finalize out on Trump's term, but basically 25 to 28. And they would permit up to $5,000 of annual after-tax contributions, and the savings would grow tax deferred. So basically, if you pay your taxes on money and you throw it into a child's account, you could put up to $5,000 in there. So you pay your taxes, you put $5,000 of leftover money into there, and then it can grow tax deferred. So as it's growing, it doesn't pay taxes right away. Presumably in the future, as money is taken out, there could be some tax implications. All of that to be determined. This would also require a social security number for both parents and the child will be automatically enrolled and receive a one-time $1,000 deposit from the federal government into their account. If you do make withdrawals for qualified expenses such as college tuition, business loans expenses, business expenses, first-time home purchase, the withdrawal would face a long-term capital gains tax rate. Otherwise, if you take money out early, you would get a 10% penalty on top of the individual tax rate. Then it says withdrawals are allowed from half of the account once the account owner turns 18, and from the entire account once the account owner turns 25. When the account owner turns 31, the remaining balance is treated as withdrawn and taxed accordingly. So it's entirely unclear there. I mean, from that read, it sounds like it kind of gets liquidated when you're 31 and just transferred to you and taxed entirely. But I'm not entirely clear of that. So TBD, some of that might still get worked out. Remember, when these big, beautiful bills or whatever you want to call them pass, we get what's in the law, and then we end up getting Treasury Department interpretation later. And that's why it's really hard to figure out what the cost of these bills is actually going to be, because they could end up costing a whole lot more money in the future because of how things are interpreted. You can see here's the present at the very moment. A vote of the bill, 216 to 2 Republican nays and Democrats at 212 nays. So plenty of votes there to complete this big, beautiful bill. Additionally, there are billions of dollars being allocated to the Artemis moon mission and for the exploration of Mars. No state regulation for the AI provisions. So in other words, let me rephrase that. a lot of states were thinking about having individual rules against AI, and there was talk that there would be a provision in this bill that states are not allowed to regulate AI, but that was removed by 99 out of 100 senators. So they're like, yeah, no, let states do it themselves if they want, let them regulate it. Okay, very well. So otherwise, practically, some practical deductions to think of is the standard deduction is going up $750 for everyone, $1,500 for couples, with inflation adjustments now, which is a change that there'll be inflation adjustments. It's expected to cost about $1.5 trillion, $1.4 trillion right there. That will move your standard deduction to $31,500 for a joint filer, $23,625 for head of household, $15,750 for a single. And the personal exemption is permanently gone. It's been gone since the Tax Cut and Jobs Act. You probably have already forgotten about that anyway. We're getting AMT, permanent increases to the AMT, child tax credit going from 2K to 2.2K, so a little bit of a boost there, not as big as some people had hoped, but a little bit of a boost, and it keeps that Ivanka Trump 2K, because it used to be 1K and it got moved up to 2K. That was one of the big Ivanka Trump, missions of sort of the first administration, which she was involved with. Right now, she's obviously not involved with politics, and she seems to get really emotional in interviews when people ask her about politics, so it seems like it sort of burned her, at least mentally, potentially the way it burns Elon as well. Some people live for it. Like Trump just seems to get stronger through it. It's kind of crazy. But anyway, permanently keeping the 2017 tax cuts, the 10 to 37% tax brackets, which would have gone up. Donald Trump says that everybody would experience a 68% tax increase. This is a little loony and kind of more like propagandish. It's fine. That's what you would expect from any politician. If it was a Democratic politician, they would have their own propaganda as well. Realistically, tax rates, like the actual tax you would have been paying without this bill, would have gone up somewhere 5 to 10%. It just depends on what you're looking at. Like obviously, if your business spending a lot of money on R&D or capital expenses like planes or machinery or H100 NVIDIA chips, some of these extra capital and accelerated cost depreciation benefits, which benefit real estate as well, would be very, could affect you substantially more tax-wise. As far as no tax on tips, it's worth knowing that we have more clarity on this now. So regarding the no tax on tips, you are able to deduct as an individual up to $12,500 of the premium portion of the overtime. So basically like that extra 50% that you get paid. So if you get paid, I'm just going to make this simple, $100 an hour, and then you get paid $150 an hour for 10 hours of overtime, that extra $50 or $500 times 10, right? That $500 would be the premium portion, and that would be deductible. So you'd be able to write that off on your taxes, even as an individual taxpayer. Now, it's worth noting that up to, there's a limit here. You can only do up to $12,500 individually, or $25,000 as a couple. That's the limit. This means the employer, because you're deducting it, this means your boss still has to pay FICA, which is Social Security, Medicare, FUTA, SUTA, those are the state and federal unemployment insurances, the employee tax training programs, or training programs, whatever, and other basically payroll taxes. So the employer still has to pay the payroll taxes, but you get to deduct $12,500 maximum, or $25,000 as joint. Now, keep in mind there's a phase out for this. It phases out at $150K single and $300K joint for overtime. The bill has officially also just passed, just a heads up. SALT tax deductions are going to $40,000 state and local tax deduction cut, $40,000 for head of household, per household rather. So SALT tax deduction going up to $40,000 per household, but it will revert to $10,000 in 2030. So basically 25, 6, 7, 8, and 9, those 6 years will have a $40K SALT limit. The larger standard deduction for seniors, this is to try to offset some of those Social Security taxes, $6,000 greater standard deduction for seniors. However, that starts phasing out if your your modified adjusted gross income, exceeds $75,000. And then for tips, there's been a lot of confusion. I've been confused by this as well. It's worth noting that the IRS considers cash tips as ordinary tips that you would ordinarily get paid in your course of business. So you can't just turn around and reclassify everything as tips. It has to be ordinary. And if indeed it is ordinary and you've been paid ordinarily as tips before, then you have no tax on tips, which include credit card tips, because cash tips are actually called credit card and cash tips per the IRS. It's the most bizarre definition ever. Why they call it cash tips, I don't know, but it's worth mentioning that. As far as rich tax breaks, the estate tax exemption is being lifted about $1 to $2 million, $15 million for individual, $30 million for joint. That's the lifetime gift tax basically going up. For businesses, we're going to get the 179 expensing, so 100% write-offs for capital equipment. This will apply on qualified property acquired on or after January 19th. So basically, like anything that you've bought that's capital equipment, it could be frankly, an airplane for use in business. It could be H100, hardware chips, whatever. Any kind of machinery for your business, you could fully expense it, which is kind of crazy. I did this under Trump in 2022, and I bought a plane, but I financed it, so I put like, I don't know, 25 or 30% down on it, but I was able to write off 100% of it. So it's actually really incredible for like motivating spending. It's a huge component of getting businesses to spend money. Very impressive component of Trump's tax policy here for businesses. Additionally, for R&D expensing, you can get full expensing of domestic research and development expenses beginning in 2025. And you can go retroactive to 2021 and accelerate some of your write-offs. Basically, you could go back to 22, 3, 4, those old tax returns, retroactively expense them. Probably means, it just lets you accelerate some of the things you've been depreciating, basically. The 20% pass-through business deduction is being made permanent. That's the 199A. And individuals taking more business deductions than their income carryovers are made permanent. So there's a 262K loss for single, a 524K loss for joint. Basically, net operating losses roll forward to future years if you take more than that for individuals versus business deductions. This would be different, though, if you had like, a W-2 and a separate S-corp. It's more like S-corp to individual. Anyway, that gets a little more complicated. We do also have dates for the clean energy tax credits. The EV tax credit, $7,500, goes away September 30th. And the home residential energy tax credits go away December 31st, which means if you wanted to buy an electric vehicle this year, you should do it before September 30th. And if you wanted to buy a home solar panel system, you should do it before the end of the year. However, there's a carve out for leasing in this. So if you lease solar panels or do a power purchase agreement, those have a few more years in it. So it's really just if you're going to buy the panels, which most people don't just go out and buy the whole panels. That's somewhat worth paying attention to. So overall, that's the main sort of core breakdown of everything that's in the big beautiful bill. Obviously, it's 900 pages long, so I'm sure I didn't hit everything, but it is official. The bill has indeed passed, and it will be on Donald Trump's desk before July 4th, which is exactly what he has been demanding. And once again, he got what he wanted. So there it is. It is official.
Motion is adopted.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.